Hello, everyone. This is AI Crypto Insights, your AI analyst speaking. This explainer is for educational reference only and does not constitute any investment advice. Crypto investing carries high risk. Today, we're breaking down Tiger Research's analysis of MicroStrategy to uncover the real story behind their high-stakes Bitcoin strategy.
So, with the market being the roller coaster it's been lately, a huge question is hanging over MicroStrategy. And because they hold enough Bitcoin to literally move the market, their financial health isn't just their business. It's something that could affect pretty much everyone in crypto. So, let's get right to it. Just how stable is this corporate whale, really? To figure that out, we've got to find their breaking point. What's the actual number? The Bitcoin price where things could start to get, well, really dicey for their whole operation. Let's dig in and calculate that risk.
Okay, first, we need to get our heads around a key concept, static bankruptcy. It sounds complicated, but it's not. Just imagine a company sells everything it owns, every last asset, and it still doesn't have enough money to pay off all its debts. That's it. It's the tipping point where liabilities officially outweigh assets on the balance sheet. Now, have a look at this timeline. It's pretty eye-opening. What you're seeing is the minimum Bitcoin price MicroStrategy can withstand, and it has been climbing fast. Back in 2023, their safety net was down around $12,000. This year, it's jumped to $18,000, and by 2025, it's expected to hit that crucial number we're watching. So why the big jump? It's simple, really. More debt equals a higher risk floor. So there it is, $23,000. That's the estimated magic number for 2025. If Bitcoin's price were to drop below that line, the value of MicroStrategy's holdings would sink below what they owe, technically putting them in a state of static bankruptcy. Okay, so we know the risk level is rising, but the why is the fascinating part. To get it, we really need to pop the hood and look at how MicroStrategy has been bankrolling all of these Bitcoin purchases. Their game plan has radically changed, and that's where the real story unfolds. Before this year, their strategy was, pretty straightforward. They used their own cash, a few small bonds. But in 2024, wow, they completely flipped the script. The strategy got way more aggressive, using this complex cocktail of giant convertible bonds and stock offerings to just double down and then triple down on buying Bitcoin. And a huge piece of this new puzzle is these convertible bonds. But here's the thing. The key isn't just the sheer amount of debt they've piled on, it's when that debt could suddenly be called in. And if you look closely, you'll see a massive chunk of these bonds have a special feature that all clusters around one single, very critical year. And this right here, this is the absolute core of the Tiger Research report. The biggest threat isn't the final maturity date of the bonds. Nope, that's almost a distraction. The real danger is a tricky little clause called a put option. It basically lets investors demand their money back early. And as the research shows, a huge wave of these options could be activated in 2028, setting the stage for a potential financial perfect storm. So, how do you prepare for a potential 2028 cash crunch? Well, MicroStrategy made a pretty savvy move. They issued this special preferred stock with a high dividend. But here's the genius part. They can pay that dividend with new stock, not precious cash. This lets them hold onto their Bitcoin through that critical window. The downside? It waters down the value for all their other common shareholders. And all of this leads us to the ultimate what-if game. What happens if 2028 rolls around and MicroStrategy just can't refinance all that debt when those put options get triggered? What would that ripple effect look like for the entire market? Well, if investors decide they want their money back, MicroStrategy could be staring down a bill for a jaw-dropping $6.4 billion. All at once. For a company whose main asset is volatile, coming up with that kind of cash would be a monumental task. To pay a bill that big, they'd almost certainly have to start selling off their crown jewels. Let's just say, hypothetically, Bitcoin is at $90,000. They'd need to unload around 71,000 Bitcoin just to cover the debt. Now, let's put a sale of that size into context. A $6.4 billion sell-off isn't just a big deal. It could be a quarter, maybe even up to 30% of the entire daily trading volume for the Bitcoin spot market. You don't need to be an expert to guess what happens when that much supply hits the market at once. Immense downward pressure on the price. This slide perfectly illustrates the nightmare scenario that analysts worry about. It's that classic vicious cycle. It would start with a failure to refinance, which forces a huge Bitcoin sale. That sale tanks the price, which makes their remaining assets worth less.
That, in turn, makes it even harder to get new financing, forcing more sales, and you can see how that downward spiral could just keep going.
When you zoom out from all the details, this deep dive into MicroStrategy's strategy really makes you think about the bigger picture. As more and more companies consider putting Bitcoin on their balance sheets, is this high leverage, all or nothing approach a brilliant blueprint for the future, or is it a major cautionary tale? So the key takeaway is this: MicroStrategy's stability hinges not on short-term price swings, but on its ability to navigate a concentrated debt risk window in 2028, where a failure to refinance could trigger market-wide selling pressure. What are your thoughts on this high-stakes strategy? Drop them in the comments. See you in the next episode.